I have three very specific goals for this video today. Number one, I want it to be educational and informative. Number two, I want it to be fun. And number three, I really want it to be interactive. Now, a typical Saturday morning for me finds me 6 o'clock a.m. in front of my TV watching the Michael Smerconish show. And this past Saturday, he showed an illustration that was tweeted out by Elon Musk, which showed Elon's political orientation from right to left over the last 13 years. Now, Elon's tweet was obviously politically oriented, but I got this idea that this concept of the evolution or the change can also be very applicable to an investor. From the early days of investing through your investing time frame, your investing career, how you evolve, how you grow as an investor really plays a big part in your success over time. Now, a lot of people watching this aren't old seasoned investors already. Maybe you're just starting off in your investing journey. What I'm going to do in this video today is I'm going to go through my evolution as an investor, and I'm going to invite each of you to submit a diagram similar to this, and you can show us your investing evolution, either that's actually occurred or what you would expect to occur. Once you have created your diagram, I'm going to ask you to email it to stickman@theinvestingacademy.ca, and we're going to select 3 winners. And for those winners, you will win a 3-month subscription to the Investing Academy. And if you are an existing Investing Academy member, we're going to suspend, or we're going to waive your monthly fees for that 3-month time period. So we hope this is a lot of fun. Hope it inspires you to enter the contest, but also just to think about this whole process of of the evolution of an investor. And I want to start with my evolution and show you my chart. So if we start right in the middle, we've got obviously a blank chart. I'm going to look at 3 time periods, and for myself, I'm looking at 1982, 2002, and 2022. And those are relevant time frames for me because back in 1982 to start, I was a 20-year-old, so just getting started as an investor. If I fast forward 20 years to 2002, at that point, I was already in the industry as an investment advisor. And then now today to 2022, where I'm on the verge of being 60 years old, I found it interesting to go through this exercise and see how I evolved. So how I evolved rather. So let's just start back in 1982. And when I went through this exercise and I started thinking of the way I invested and what my thoughts were on investing way back in the day, a few things came to mind. First thing that was obvious to me is I was very enthusiastic. I was a very positive, I had a positive outlook on investing. And most importantly, I just felt that I wanted to be rich. And I mean, I meant really rich. I remember thinking, I guess not just thinking that, or not being aware of the obstacles that life throws at you when you're younger, but that's also applicable to the investing standpoint. The one thing I didn't think about most of all now when I have the luxury of time to look back, I saw the positives of investing, but I didn't see the risks that are associated with investing. I didn't see the downside or the hurdles that you have to go over to be a successful investing. And when I look back to my earliest ventures into investing, and this is not that uncommon, I invested in penny stocks. I invested based on hot tips. I worked with a group of guys back at the time who actually were big into horse betting, and they would tell me all their stories of their winnings. And of course, most of us share our winnings, but most of us don't share our losing stories. What that taught me, or what that showed me early on in my investing career, was that spotting trends, whether it be penny stocks, and you can see a stock go up, down, up, down, up, down, and you figure, okay, well, I'm going to buy it when it's down, it's going to go back up. And of course, that rarely, generally for some reason, that's when the pattern breaks. Or horse betting. You think that you can spot these trends, and that will set you out on a successful path. So many people learn that that isn't the case. I found myself making a lot of short-term trades. In fact, very short-term trades with a goal of making a quick buck, then getting out and then repeating that. When I was younger, I had dreams, but what I didn't have was context, or I didn't have the fuller concept of what investing was all about. And I guess that's just the way it is when you're a younger investor starting out, or when you're any investor starting out without any life experience. When I put that on my, if I translate that to a chart, then if I look at the top timeline of 1982, I would put myself right here. And this is an aggressive position. And again, for all the reasons that I just articulated, I had a good positive outlook on investing, but I didn't really understand what that path was about. Now, I'm going to fast forward to 2002. So now we've gone 20 years with these investing experiences, and something significant happened to me during that time. In 1994, I actually got into the industry. So I became an investment advisor. And clearly, a big shift, aside from my experience as an investor at that point, was that I had a lot more education. So I had taken all of the training essential to becoming licensed. And so I had a little bit more context, or at least some book smarts. And something else really important happened. I was taught a lesson in in how the markets really work, because in 2002, for those of you who remember, we experienced the tech crash. And so as a younger advisor, and at this point, keeping in mind, I had my own money invested, but I also was responsible for other people's money. When we look at what happened from around early 2000 through to 2000, at the end of 2002, clearly one of the biggest market crashes in history. And hopefully this would teach someone some lessons. Here's what the 20 years between 1982 and 2002 taught me. First of all, this value versus growth argument was heated up in the late 1990s, and so leading up to 2000, a time that similar to what we've seen recently with tech stocks, is that if you were a more traditional investor, you were being left behind. So the blue chip companies, the value companies out there were old school, and growth was where it was. And if you're a student of history, or if you lived through that time frame, we know that the tech crash was really, really hard on a lot of investors, and virtually everything dropped in value. But of course, growth got hit the hardest. Those internet stocks, similar to what we're seeing today with a lot of the meme stocks and the tech stocks. I also remember this conflict that I had between risk and reward. Again, being younger, my life experience wasn't what it is today, and I was human, and I think of this risk versus reward, and I think of the emotions that come into play when you're an investor. Clearly, going through the big buildup leading up to the tech crash, there's a lot of reward that we saw. And then going through the tech crash, we saw the commensurate risk that goes along with that. So the emotions that we felt as humans, I vividly remember being so conflicted between it when the markets were going up, you want to participate, but it just didn't feel well, or you want to maybe participate for sure, but you wanted to load up on those high flying stocks. That's what you felt like doing, but your brain was fighting with that and telling you that it wasn't necessarily the thing to do. Now, back in those days, my portfolio would have been entirely mutual funds, and for the clients that I worked with, those were particularly more heavily weighted in mutual funds as well. That didn't save us back then. When the markets dropped, of course, whether it's a mutual fund or whether it was an ETF, everything dropped along there as well. This is also around the time frame that I remember conceptualizing the fact that when you're a shareholder in a company, you own the company. And that has always stuck with me. And now, whether I own an individual stock, and we're going to talk more about 2022 just in a minute here, or whether I own an ETF where you're a part owner, this concept really started to sink into me, where when you buy a stock, you are buying ownership in that company. I know it sounds pretty simple, but a lot of people still today, and I guess always will, treat a stock as not a real thing. It's more like just, a book I read years ago talked about a blip on a computer screen. And we're sort of encouraged almost by the media to trade and to think of things that way. I think that changed my investing stance, my experience about going that route. Another thing that really resonates with me during this time period was the tremendous value of investing on a regular basis with a pre-authorized contribution. Now, we look back at the chart and we'll see markets drop somewhere in the range of 25%, 35%, as far as 66% for the NASDAQ. And in fact, during that time, the NASDAQ dropped around 75% from its peak to trough. For those who had the commitment, the discipline to continue to invest through those time periods, hopefully in good quality stocks that are actually still around, you'll see when coming out of that, the dividends were paid off there, where when the markets recovered, of course, you owned shares, whether it was a fund, whether it was an ETF, whether it was an individual stock, at a much lower cost base. And so the concept of having a plan and being committed really, I was taught during that time frame in real terms that there is a lot of value to that. When we look at my illustration, so we look at 2002, what was the change from 1982 to 2002? Well, I shifted to the left. So the left being more conservative, the right being more aggressive. Without a doubt, I shifted to the left, but certainly not even to the middle. I was much too young. I was at the time, I guess, 40 years old. Too young to say I'm going to tuck my money under a mattress. And of course, I still had a lot of growth, a lot of objectives to create wealth and to build up my accounts. And so I shifted from total transition from the penny stocks and the more aggressive and investing based on a hot tip to what I would say, and I would maintain today, a more disciplined, strategic, wholesome way of investing. Now, when we fast forward to today, so 2022, where do I fall on this chart? Well, one of the benefits I guess I have today is I have 40 years now of experience as an investor and 28 of that as an advisor. So I not only went through my own experience, my own emotions, etc., but I saw the emotions and the experience of the clients that I worked with, and you can learn a lot from that. So what did I learn? One thing, really important. Even today, I am still a human being. I'm still tempted, I guess you would say, like everybody else, when there's an opportunity to make money. So it's really important. And I think I learned this long ago, and I'm fully committed to this today. The temptation to go off of your path will always be there. A difference between 1982 and today is when I'm tempted, I also have a discipline that comes along with that. And I fall back on experience and go, when you felt tempted before, how did that work out? And either personally or observing the markets in general, clearly to me, I believe that having that plan, having the discipline will trump being tempted to follow the crowd. Another thing that I really am more firm on or understand now is, as an investor, I know what matters to me. And this will be different at different stages of life. But I think a lot of investors don't really think about it in those terms as to who I am as an investor. And a couple of things for me. Number one, I'm not into drama like I may have been 40 years ago. And when I say drama, I don't mean, like right now we're going through what I would call a dramatic time in the markets. Just before I shot this video, I looked at the markets, and the Dow Jones was down 1,000 points today. Now, in 2022, that's a big drop, and so there is drama in the markets. But that's not what I mean. What I mean by drama is the Reddit, the hypes, the meme stocks, the just those crazy things that from time to time come up in the markets that will take you off your course. I'm not interested in the extremely high risk companies or investments where you can make a lot of money, but you can lose a tremendous amount of money. Somewhere in the middle, definitely more suitable for me, but that's me as an investor. Each person has to determine where you are in that. I want to feel secure with what I own. And every company that I have in my portfolio, with the exception of one, for those of you who are followers of the channel, my investment experience, you know that to this day I own Ballard Power, which is a very speculative investment. And I've done videos in the past as to why I continue to own it today, but it's so out of character for the types of companies that I do own. But I want to feel secure that the companies I own are going to weather the exact storms that we're going through today. Where am I on that spectrum? Well, a lot of people will probably be surprised, possibly, to learn that today, or as of 4 days ago, as of April 30th of 2022, my portfolio is actually 77% in equities. So definitely I'm geared towards the equity investments. I fully trust that if you have good solid investments in the equity markets, those will provide you with growth and it will maintain and conserve your wealth as well. There's a debate whether you own ETFs or you own stocks. So if you're owning equities, it could be in the form of a fund, or it could be in the form of stocks. And I wish the debate would just kind of end, because there isn't a right or wrong. It's depending on what's more suitable for you. Personally, the vast majority of what I own, are in individual stocks. Now, I enjoy managing a portfolio. It's just in my makeup. I've done it for a long time now. I'm not worried about there's the concept that if you own individual stocks, somehow they're all going to become worthless. but if you own an ETF, they won't. I don't ever get that, but that's a concept out there. So, but for me, I enjoy owning them and I feel comfortable owning stocks. Now, what I don't want to do, I don't want to own 500 stocks or 800 stocks. And if you own a lot of ETFs or a combination of ETFs, that's what you do own. That's fine if that's for you. For me, I today own 30 different companies, and that's a manageable number for me. The important thing is they're all blue chip companies, with that rare exception, like I said, with Ballard Power. And if you have a quick look here over the makeup of my portfolio, this is just the sectors that I'm invested in as of today. Fixed income makes up 16% of my overall holdings, and then you can kind of have a look for yourself there. Financials, consumer staples. I have over 12% in technology, and that might surprise some people because, we look at the markets today and we tend to think of technology as aggressive, and they are. They can be aggressive. We think of technology as speculative or risky. As part of an overall portfolio, in my circumstances, there is a space for that. We look all the way down to the right of the table. The only sectors that I'm not diversified into right now are materials and real estate. I do have a couple of ETFs. I have a couple of small ETFs. I have an ETF that I get more global diversification, and one where I have some U.S. diversification. Those are more for as a couple of smaller accounts where it doesn't make sense in those particular accounts to build up a portfolio of individual stocks, so I use ETFs for those purposes. When I look at my line chart, so where I am today, if I look at quite aggressive back in 1982, I look at less aggressive back in 2002, and when I look today, I would put myself right here. And in 2022, I still by far am more on the side of risk versus non-risk. There may come a day where everything's shifted, or I'm shifted to the left of that center line. I'm not sure if it will or not. I know I'll always have some money invested in some of my favorite investments, some of the favorite companies that I want to own. This is where we get to the part of you and your chart. And what I'm going to ask you to do is to create an illustration like I've done here that shows your evolution. Again, if you're a longer term investor, how have you evolved? If you're a younger investor, what do you anticipate? And I'm going to ask you to be creative. I used a pretty bare bones illustration for this, but be as creative as you want to try and drive home the point of your emotions, your feelings, your journey. Once you've done that, email it to stickman@theinvestingacademy.ca. Feel free to check out our Investing Academy webpage. The link will be provided below, and we're going to pick the top 3 entries that are creative and show your journey. And in a future video, I'm going to cover those off. So hope to get your submission. We'll have the window of opportunity open for 1 month from today. So go ahead and do that. And I thank you for watching the video. Look forward to your submissions, and I look forward to seeing you in the next video.